to disturb you during your lunch time and all. But he has given me a big list of the agenda items starting from the secondary database onwards to your econometrics. And you know, econometrics is such a vast course, it needs 2 semesters to cover. But what I have structured my class in such a way that I will go by Minna's suggestion. I will first discuss something about issues, challenges, opportunities of the information collected and compiled from the different source of the secondary database, and how you are going to handle that, and how you are going to detect or identify this is where you can collect your information. So some kind of collecting all kind of social science research from the different verticals. So I have collected a PPT for this different kind of databases. I'll go through that first very quickly. I'm not going to consume much time on that. And after that, immediately we'll go for the time series analysis. Before jumping into any packages and all, what we can do actually, we are going to discuss about what are the basic concept of the time series, what are the issues and challenges whenever you are dealing with the time series data, how you are going to overcome this kind of limitations. And after that, I will show you some of the practicals. So my entire presentation is just to alert you, because now there are a group of scholarism or the scholastic ideas have been developed where people are actually criticizing the econometrician or the statisticians. They are actually abusing the statistical tools. And why this abusement is coming, and where are the challenges and where are the problems, and what kind of research ethics, modeling ethics, and econometrics ethics we have to bring in, that we are going to discuss through all this kind of analysis. So let me go through, let me share the entire screen if that is possible for me. Yeah. So is my screen visible?
Yes, coming, sir, coming.
Let me go through the full mode. Yeah, Mina, it is visible?
Yes, now visible, but no written document. Only.
What is that?
Only white skin is visible. But only white skin, nothing there.
What about now?
No, nothing.
Okay.
Yes, now it is visible.
Now it is visible?
And just if possible, just make full screen. Now it disappears.
Yeah, just a minute.
Yes, now clearly visible. Just make it full screen.
Yeah, is it full now?
Yes, now, yeah.
Okay, great. So let me go to my first slide. It is visible?
Yes. Just
Okay.
make it a full screen, yes. Yeah.
Now the slide is visible because I have already done the full screen.
Okay. Okay, no problem. You continue. I hope it is visible, but with small letter.
Okay. Fine. I'll share all these slides. That's not an issue at all. So let us not to spend the time on these technical issues. Okay. So we are talking about the research methodology or the data analysis for the social science, our entire concentration is revolving around a concept or a word called as data. What we understand about this data, what we are supposed to do with this data, and why this data is important. So let me put this data while understanding in a two-dimensional coordinated plane. Why? I'm measuring your level of improvement on decision making is on your x-axis, and level of exactness of the statistical model in your y-axis. This is my thought about the statistical modeling. Whenever you have some set of information and you'd like to bring some kind of logical inferences out of this data by applying some kind of decisions tools and to generalize with the population. So data is nothing but the information, and information might be asymmetric, information might be symmetric, information might be homogeneous, information might be heterogeneous, information might be qualitative, or information might be quantitative. So from the data, we are actually extracting the information. And once you are compiled that information, whether it is the absolute information or whether it is a relative information, whether it is the authenticated information, once you are establishing that fact, that what kind of information it is, then what you are doing, you are applying some kind of decision sciences tools. So in our statistical parlance, we are using a singular version of statistic and a plural version of the statistics. For example, your t-test, z-test, f-test, chi-square test, or your joint probability test. And whenever you are coming to correlation, regressions, they are the plurality form. Or in case of your regression, R-square, Darwin-Watson, log likelihood, these all are the plural version of the statistics. So from the information, you are trying to implement some kind of parametric test, some kind of non-parametric test, and sometimes you are combining or applying the different decision sciences tools. What are your decision sciences tools? Your statistics is a decision science tool. Your mathematics is a decision science tool. Your physics is a decision science tool. So all these kind of tools you are using in order to extract the different facts, either through a deductive approach or through an inductive approach. And these facts are nothing but you are extracting with some kind of logic, some kind of logical inferences out of that information. So especially data absorbs the information. You are extracting that information by applying some kind of tools or decision sciences in order to extract the facts. And after that, that facts, how, whether you can generalize it to particular or you can particular equate to generalize. So out of that facts, whatever the logical inferences you are drawing, and that you are providing as a knowledge system. So especially data ends with a knowledge system by collecting, compiling, applying, and implementing, and after that you are analyzing, and again you are checking whether it is true to my population or not. So that is why your knowledge, however, can be expressed only with some statistical degree of confidence. So whenever, let us say, to substantiate this, you are saying that, let us say in the you are making a statement, the likelihood of the central government will fall down in the next 3 months is 80%. It is a statement I'm making. So whether I'm going to accept your statement or I'm not going to accept a statement. Let us say there are two statements are available. One, you are saying that 80% you are confident. Another statement, you are saying that the central government is not going to lead the country in the next 3 months down the line between 85 to 95%. So whenever we are making any kind of information, or we are making any kind of statement, which is drawing from the facts in terms of the knowledge, and we are making a statement, we are always assigning a confidence interval. Why we are assigning confidence interval? How confident you are to make this statement. Why should I believe you? Why should I trust you? How far your statement is true? So that is why the statistical confidences or your confidence to make this statement is always associated with this kind of statement. So overall from this slide, what I'm talking to about, what I would like to make a point. So your data is nothing but the information. Information leads to the facts, which is extracted to your decision science tools. And after that, you are making some of the knowledge, and this knowledge is actually generalizing to your population. I will come down whenever you are making your sampling, whether you are make that sample is going to be a superset of your or generalization of your population or not, whatever the challenges we'll discuss when the right time will come. Now, coming to your different open or secondary data sources for the social science researchers, let me come with the different kind of databases. For example, if you look at nowadays the kind of research we are doing, many people are actually using the World Bank open data. So what kind of open database World Bank is giving? So it is the website is called as data.worldbank.org. So it is compiling all the countries, the databases in terms of the development data, economic, social, environmental, climate, country profiling, any kind of data whenever you are going across the studies, across the countries, or the cross-sectional studies, or the developing countries, Asian countries, European countries, whatever the point. So this is an open database nowadays. It is available. It is called as data.worldbank.org. So there you can collect all these kind of development indicators, demographic indicators, economic indicators, social indicators, environmental indicators, and openness indicators. All the data you can compile from that. The second data people are grossly using nowadays is from the United Nations data. The basic website is your data.un.org. So there you can collect major United Nations database, including your statistics on demographic, economy, health, and more member countries. The third one is called as Eurostat. Eurostat is fairly covering all the statistical office of the European Union. If somebody is actually concentrating on the European countries, demographic like economy, population, health, social conditions, migrations, or any kind of things, that also you can extract from your Eurostat database. Next one, you all know that there is a census data. In case of the US, it is the census.government. In case of the UK, it is ons.government.uk. Or in case of the India, it is censusindia.gov.in. And many people, you are already aware of this database. The next set of database is called as your Pew Research Center. pewresearch.org is the specific website, and this website gives the data on your social trends, public opinion, demographic research, primarily focused on the United States, but including all the global perspectives. So if you are doing any benchmarking studies through your Delphi method, Murphy method, or NAEP method, this database is especially very useful for you. The next one is your Inter-University Consortium for Political and Social Research. A specific website is there, icpsr.umich.education. This is a vast archive of the social science data, including your database on education, criminal justice, political behavior, and health. So if those people who are working on the political stability, economic stability, macroeconomic stability, or the social stability, there you are going to get this kind of data. Another database you have, it's called as GSS. It is called as the General Social Survey. So this database is actually giving a sociological survey or an anthropological survey, which is used to collect the data on the demographic characteristics and attitudes of the different countries' population, but especially it focuses on the US-based population. So there also you can collect the different kind of information. The next database is coming actually integrated public use micro data series. Those people who are actually working on the microeconometric model, and especially depends upon the questionnaire method or survey method or your primary or the qualitative data approach, you can also extract the information from integrated public use of micro data series. This provides your census survey data from the US and other countries, and harmonized across the time and data sets. So this is a very good database to extract the different kind of information while you are doing any kind of comparative study across the countries. The next one is your demographic and health surveys. So the specific website is your dhsprogram.com. So this gives the information where this website, it collects and compile and disseminate the data on demographic parameters, population, health, urbanization, nutrition, food security in all developing countries. So those people who are working this kind of research, they can directly extract the information from your demographic and health surveys. And the 10th one is called what? Your World Value Survey. Worldvaluesurvey.org. This provides a global research project that explores people's values, beliefs, trust, and how they change over time, especially those who are actually working on the social behavior. Can I quantify the social behavior? Can I quantify the perception of the people in the society? Can I anticipate the community's behavior towards the social values? So this kind of, those people who are working on this kind of behavioral or cognitive concept of the social matrix of the social behavior, they can actually extract the value. So this is the World Value Survey. Depending upon the different kind of clock time or the journal studies, the survey was compiled, and you can directly extract the information from World Value Survey. Now coming to the 11th one is your Harvard Dataverse. So this is called as the website is dataverse.harvard.edu. So here what kind of, this is a repository for sharing and citing and analyzing what kind of preserving research data you can collect from this, from the different disciplines. Next one is your Global Health Data Exchange. Those who are working on the demographic data, you can directly collect from this. And Luxembourg Income Studies. Those people who are actually working on the cross-national data on income, wealth, and employment demographics. Nowadays, a separate vertical is called as wealth dynamics, or what kind of employment or demographic parameters. There you can actually use this kind of Luxembourg income study. The 14th one is your Social Science Research Network. Social Science Research Network is a repository of the research papers across the social science. This is actually open database. You all might be aware of this. I'm not getting into that actually. The next one is called as your Open Science Framework. So here it is again a free and open platform to support the research and enable collaboration. This including the data set of the project documentation. So different people at different point of time, what kind of information they have already gathered, you can actually use this database without going for the further field study. That is the point. Now, if you come to the India specific database, the first one is called as your Reserve Bank of India database, which is where Handbook of Statistics of Indian Economy, the time series data, you can get it. And at the same point of time, you can get the cross-sectional data. And at the same point of time, you have currency finance, financial stability report, and different kind of RBI bulletins with the different kind of short piece of research is also available along with the findings. So Reserve Bank of India for public finance statistics, for the state level data, government expenditure, revenue, and all Indian economic database, or all your macroeconomic variables like your money supply, output, prices, exchange rate, inflation, current account, capital account, volume of exports, imports, everything is available in the Reserve Bank of India database with all the frequencies, like your monthly frequency and your annual frequency, as well as the other one. The second one is called as Ministry of Statistics and Program Implementation, MOSPI database. Here I just would like your attention that most of us are actually directly getting into the different kind of database, but we are not actually using the MOSPI database very often. But let me alert you, MOSPI is providing all authentic data on your national accounts, inflation, employment from time to time, and with the different geographies, different regions of the country. So I would like to urge all of you, you exercise the MOSPI database whenever you are working on the secondary database of income, output, employment, and all. And you all know that the National Sample Survey data is also provided by your provided by your MOSPI. The third one is the Niti Aayog. Niti Aayog is also started compiling the data on different kind of, you might be heard about your multidimensional poverty, your SDG index, and different kind of research, starting from the financial research in terms of your corporate bond, in terms of commodity future, in terms of the social parameters, everywhere country specific and state specific analysis also is provided by the Niti Aayog. Next one is your, in case of the India, it is called as IndiaStat, indiastat.com. So this is a very comprehensive database. These also offering data on various sectors like your Indian economy, including your agriculture, industry, finance, external sector, trade, many more things, whatever you are actually looking for. So IndiaStat database is also providing both the time series as well as the cross-sectional information. Center for Monitoring Indian Economy, you all might be aware of CMI and the Prowess database. In terms of your industry database, farm specific database, and your economic database, plus your country profiling or the across country database, that is also available in case of your CMI database. Then another database in case of the India is called as Open Government Data Platform India. So these data are available on data.gov.in. This is the official open database portal of the Government of India. This is offering across the various sectors, including your agriculture, industry, service, trade, what is that called, housing, tourism, travel, everything, all the data, energy, climate, all the data are actually compiled over here in this Open Government Data Platform of India. Next is coming for your Economic Survey of India, that is available in the indiabudget.gov.in. So economic survey every year, economic survey is also compiling all the information, whatever is available periodically. They are providing actually different kind of annual reports on the state of your state of your Indian economy, including your data on GDP, sectoral performance, other economic indicators like your fiscal deficit, budget deficit, government what is that called, FRBM Act, everything, whatever you take. So Economic Survey of India. Next one is coming actually those who are working or concentrated on the Indian financial sector or the financial market in terms of your equity market, your government debt securities or the bond market or your fixed income securities market, or your derivative market, commodity market, credit derivative market, banking, or your bankruptcy related instrument, or your banking efficiency or non-performing asset. So whenever you are looking for this kind of information, your concentration should go for the Security Exchange Board of India. For example, those who are working on the financial stability, financial depth, or financial openness indicators, like your financial openness, trade openness, and your FDI openness in terms of volume, in terms of size, in terms of turnover, in terms of the volatility of any specific market or sector specific markets, all the information is actually being compiled in the Security Exchange Board of India. Most of the time, all the informations are available either in terms of the PDF format or in terms of the data depository format. So that is why you can use in terms of your Security Exchange Board of India database. The next database is called as Trade Data from Directorate General of Foreign Trade. It is called as a DGFT. If you go for the dgft.gov.in, it provides the data on your external specific sectors. For example, India's export and import trends, trade policies, trade agreements, and regulations or circulars related to this kind of external trading. For example, your balance of payment, current account surplus or deficit, your capital account, volume and receipt of the exports and imports, or if somebody is actually working on the exchange rate, what is that called, to explore the exchange rate exposure, whether if your concentration is on the export promoting industries or the import substitution firms, all the related information, or those who are working on the exchange rate exposure like transaction exposure, transnational exposure, operational exposure, or the economic exposure, they can actually focus on this kind of trade data from Directorate General of Foreign Trade, that is called as your DGFT. The next one is called as your National Sample Survey. It is available in the MOSPI. Those people who are working on the large scale sample survey on the employment, labor studies, or Indian life, including consumer expenditure and health and all, that you can actually focus on the NSS of the different surveys, even urban migrations and all. And apart from that, there is those people who are working on the healthcare. There is also NFHS database and all. So NFHS 4, 5, 3, 2, all these are available. Next is coming actually annual survey for industries. That is also being compiled by the MOSPI. You can directly target the different kind of industry specific or the manufacturing sector. For example, if you are working on the research and innovation or total factor productivity of any kind of farms, industries, or any kind of farm specific factors in terms of systematic risk or the non-systematic risk, or in terms of the production, employment, investment, or in terms of the structure, conduct, and performance of the different kind of efficiency of the industries, then those people or those researchers, they can directly extract the information from the annual survey of industries, and the different classification and digital classification of the industries are also provided by your annual survey of industries. The next was census data. I have already discussed. And coming to your Center for Policy Research, those people who are actually working on this kind of urbanization, governance, and economic development. For example, if somebody is working on the urban planning, urban designing, urban infrastructure, urban governance, and urban finance, you can take the data from the Center for Policy Research. Apart from that, you can go for the Indian Public Finance Statistics or ICRIER database, or your economic, the 15 or 14 or 6 Central Finance Commission database, State Finance Commission database, as well as the ASCII and ICRIER database. So there you can compile all this kind of information altogether. Next one is called as your India Environment Portal. So this offers the data in terms of your environmental economics, including the impact of economic activities on the environment of India. Okay, so there is a specific environmental indicators. All the informations are actually available in terms of India Environment Portal.org.in. So there you can extract the different kind of information. Nowadays, while going through a lot of research paper, I am finding that a lot of people are actually working on this coronavirus pandemics or the sustainable development goals and all. So there, if you look for all the coronavirus information, like total rate of the how many people, total number of people are actually affected, how many are susceptible, how many actually infected, how many are quarantined, what is the strength of the vaccination and all, and the different waves of this coronavirus and all. Till today, there is a fantastic database I found that is called as Coronavirus Pandemic, Our World in Data. It is available. I have given the website. I will share this PPT. You can go through this website. So very comprehensive data. In fact, many people, by just simply taking into the total number of people are infected across the countries, they have predicted the different waves. And a different kind of literature altogether has developed after this COVID-19 pandemic. That is called as epidemiological models. So those people who are actually working on the epidemiological models, they can directly extract this kind of information, and different pages of the information is available actually with the different 4 kind of stages. The moment you are infected, then you are isolated, then you are quarantined, then you are vaccinated, and after that, the follow-up. Each stages of the methods through your SAR model and generalized SAR model, all the information is actually available from the across the sectors, impact of COVID-19 with respect to the different sectors and all. The next one is called as your Economics Intelligence Unit. Economic Intelligence Unit is actually specific to the energy sectors. Now, most of the people, they're actually working on the energy security, energy financing, and energy sustainability in terms of the renewable energy and non-renewable energy. So there, one open database is available, what is called as your Economic Intelligence Units, even forecast and nowcast, both backward testing and forward testing with the different scenarios of the different countries. Database is also available there. Now, the next database was called as Asian Development Bank of the different indicators. So they are covering both the demographic, economic and output, money, finance and prices, globalization, transportation and communication, energy and electricity, environment and government and governance, including all the Asian countries' economic indicators. All these data, they are actually available in case of the Asian Development Bank. And apart from that, those people who are working, you can also target for your IMF staff papers. So this is a very comprehensive database that I'm talking about in terms of your what are the different social science database that you can actually use. So any question on this? If anybody has any specific things to say.
Good morning, sir.
Yeah.
Sorry to interrupt you, sir. Please, sir, can you make your slide into a slideshow mode so that we can, so the content will be visible, clearly.
The slide is not visible.
Slide is visible, sir. It is not on a slideshow mode. So the font and content is very smaller, sir.
I see. Just help me out. Let me do it in the slide mode. Is it now visible?
It seems visible, sir.
Now you can see the slide mode. It is the font size and all, everything is fine with you.
Yes, sir. It seems like that.
Okay.
Sir, I have one question, if you allow me.
Yeah, please go ahead.
Yeah. So I'm just wondering that where from we get the migration data and specifically the coastal region migration data. Is there any source for migration data?
See, migration data is especially available in terms of the NSSO surveys.
Okay.
Most of the people they are taking from there. And apart from that, Indian, this international ILO database, have you gone to the ILO website?
No, sir, I am more concerning about Indian.
Yes, I'm talking about India only. So their country-specific data is also available.
Sir, NSS and one more thing that you have said, will you please repeat it? NSS data, yes, and
International Labour Studies, ILO database.
IN.
Sonal ji, please.
Hello, good morning, sir.
Yes.
Hello, good morning, sir.
Yeah. Please tell me.
Sir, I have one question. Is there any data like reverse migration?
Reverse migration is a concept which has been developed after this COVID-19 and all. As you know that in India, we don't maintain neither the migration database so authentically. So, and reverse migration also neither we have done. But in bits and pieces, most of the organizations like Tata Institute of Social Science and the different kind of urban labs in Bangalore and Hyderabad, they have maintaining some kind of database in bits and pieces. So on reverse migration, there is no authentic database has been developed so far yet in the context of India.
Hello, good morning, sir.
Yes.
Sir, I'm Ravindra Kumar. I want to know if there is any data available on the gig economy in India or across world.
Yes, you can check to the international ILO website on the gig economy.
And in regarding India?
Regarding India, the informal, there is no specific gig economy because it is a recent and contemporary topic. But the informal sector, unemployment and all, there are a lot of databases available. If you go to that Ministry of the Labor and Employment, you can get that informal sector employment and street vending. So there you can get some information about the gig economy.
Okay,
but of course, nowadays IMA and World Bank has also started compiling on the gig economy database.
Okay, thank you.
Yeah, but it is at a nascent stage. You may not get huge information for study and all. So you need to compile, you need to combine with your survey method with this kind of secondary data analysis.
Okay.
Yeah. Now I'm coming to the analysis of yes.
Hello, sir. Good morning.
Yeah, good morning.
Sir, so any kind of resources available for automation related data?
Automation.
Huh.
Automation or automobile? Automation is that you will need to combine all these things to automated. What do you mean by automation?
Like any data regarding the farm level where the industry, the farm try to try to make like whether they are in the production process they are adopting new technology that would have been any kind of effect like this. That is related
Okay.
to that.
Are you talking about the value addition and innovation database in the farm and industry level?
Yes.
Okay, for this actually there is no specific database because none of the farms actually giving on the research and innovation database. But yes, there is a division in each of the farms. For example, if your objective is that you go for the pharmaceutical industries, or you are going for the steel industries, or you are going for a specific industry sector, you can do a sampling method, and you have to visit that particular company or the industry to extract that information. Recently, 3 studies have been done in IIT Hyderabad, where they have gone to that particular company, sat with them, and their total investment in the research and the innovation, and because of that innovation, whatever the product and it has quantified in terms of the output, that information they extracted, and they have quantified the innovation's impact on the farm's output and all. So there you can do different kind of total factor productivity analysis and all, or your structure, conduct, performance of that particular company, and that impact of the innovation on the farm's output and the growth. But there is no secondary database on this innovation data and all.
Any world level resources?
Yeah, you can
Not
check in
only
that you can check in that World Bank database and IMF star papers on the product and innovation of the manufacturing companies.
okay. Thank you.
Hello, sir.
Difficult if you are working on the financial firms or the non-financial firms. There it will be difficult for you to get. Okay.
Hello, sir. Good morning.
Yes.
Sir.
Yeah, Manoj,
Yeah,
carry
please
on.
go ahead.
Sir, one more doubt. Sir, any other resources regarding the informal or temporary labor force participation, that kind of resources?
Yeah, that is available on your NSSO database. This is also available in that informal sector in terms of our labor and ministry employment database, and that is also available in your international labor organization database. But the 3 things you have to check and combine while you are creating your own database. Sometimes people are actually merging and converging by all these 3 kind of databases. And yeah,
we need to have compile it, right? Not
yes,
merging.
You have to extract the information and you have to merge and converge to create your own database for the for a larger sample and all.
Okay. Thank you.
Hello, sir. Good morning.
Yes.
Sir, my query is the database that you taught. Some of them are paid database like CMI and India State. So for that, where we can get free data?
Whatever the database I have discussed over here, that is nothing called paid database. It's all are open database. Paid database,
few.
not a single one I have not.
I think CMI and India State, they need subscription. Okay.
Okay.
Then only we can access.
Actually, CMI database, actually it is available in most of the universities and organizations. That is why I thought I will put it. Otherwise, apart from the CMI database, the other databases is completely open. For example,
India
what
State also.
information you require?
Sir. Okay, sir.
Likewise, there is a called as CEIC database. They are providing global database. They are providing this India high premium database, and they are also providing regional specific database. Apart from that, they are also providing the different kind of comparables and reports. So nowadays, I was told that most of the universities, even state universities and all, also they have access to this kind of CEIC database. So if you are working on any kind of universities, or if you need specific information, I have the access. I can also provide you this information if you have any specific research to do that.
Okay, sir. Thank you so much.
Okay. So if no more question is there, shall we go ahead with our time series econometrics now?
Yes, sir. Yes, sir.
Yeah. So welcome back to the time series econometrics. So what I'm going to discuss in this section, that why at all, whenever the classical econometrics was there, why there was a need for the time series econometrics. Okay. If the classical econometrics database was there, why at all we need this kind of database called as your time series econometrics. So you all are comfortable with your this classical econometrics. For example, what is a data, what is a variable, what is a regression, what is a causality, all these things. Or we are talking about autocorrelation, heteroscedasticity, multicollinearity, different kind of assumption, R-square, and all these things. So all this information, I'm sure you must have already studied somewhere, either in your master or somewhere. So now the time has come to understand why time series at all, and why it is called as time series econometrics. So in a classical linear regression model, you might have already understood, because we are starting with a called as two variable regression model. What is a regression? So regression is nothing but it is a relation or linear, either linear or non-linear. If it is linear, it is called as linear regression. If it is non-linear, it is called as non-linear regression. So in case of, let me, for the sake of simplicity, let me take an example of linear regression. Let us say consumption is a function of income. So if you remember your macroeconomic stage, what you are doing, your law of psychological consumption is saying that psychological consumption is saying that if income increases, consumption will increase, but it will not increase in the same space, right? So that means proportion of increase in income is higher than proportion increase in the consumption. So having said that, we are saying that consumption is a function of income. So in this regression equation, what you are saying that if your income increases, you are actually measuring how income is actually determining the consumption. That means your consumption is completely dependent upon your income variable, right? So regression is talking about the linear association and the dependency of consumption with respect to your income. What do you do in this case of a regression? You are regressing, you have the consumption data, you have the income data, you are regressing consumption and the income. Then you are going to get your coefficient in terms of your constant and your consumption parameters in terms of beta, and there are some error variable. After that, what you are seeing, you are looking at the goodness of fit, what is called as your R-square, right? So you are saying that if you have the consumption and income, how well or how good fit both the consumption and income in terms of your R-square while fitting a regression line or a trend line, correct? So in this case, what you are saying, what your R-square is telling, that it is actually maintaining, or it is actually measuring the distance of each of the point in a scatter plot from that regression line. And after that, how do you are actually computing in terms of the regression? You are actually either applying a maximum, your ordinary least square, or you are applying your maximum likelihood of the estimates, right? So in case of a regression, while you are applying this ordinary least square, why it is called as ordinary least square? Least square means you are actually minimizing the error. Which error? Square error. You are minimizing ordinary least square. So you are minimizing your square error term in such a way that you are going to get a optimum value of your alpha and beta. That is what it is called as regression. So then again, you are going for the different test, like different kind of test, like your autocorrelation, your multicollinearity, your heteroscedasticity, and all these things. But let me tell you, come to your dispersion measure in terms of your statistics. You might have heard about your absolute dispersion, relative dispersion. You might have already studied your range, quartile, mean deviation or absolute deviation or standard deviation, coefficient of variation. These all are called as your dispersion measures. So in this kind of dispersion measures, what you are doing actually, you are computing how each of your variable is actually dispersed from your average value or your mean value, right? Let me give an example. How you are computing the standard deviation? That is your under root of summation x square upon n. What is your x square? X square is nothing but the x minus x bar, right? So let us say you have the income pattern of all the 29 states with you, and you would like to compute the average income of all the states. And after that, you would like to see the variation of each of the state's income from that average income. So what you will do? First of all, you will take all the data. You will compute their average mean value. After that, you are going to compute the dispersion of each of the income variable from that mean, right? Now, while doing this in the time procedure, I just would like to bring to your notice that the mean is constant across the time, right? The mean is constant. But in the practical life, do you think that the average value is constant? No. That is why in your entire macroeconomics, we are talking about three kinds of equilibrium. We are talking about static equilibrium. We are talking about dynamic equilibrium. We are talking about what is that called? Comparative static equilibrium, right? So nothing is constant, and constant is the only change in the life. So what does that mean? That means whenever in the statistical procedure, while computing your dispersion measure, you are assuming that the mean is constant across the period. But actually in the practical life, mean is not constant. And if mean is not constant, and if it is with respect to the time, and time is nothing but it is very valuable and very powerful, which it changes across the time, how can I assume this kind of constant mean? Okay. Now, in your economics, if you look at the two kind of policies you have, one is called as your monetary policy, second one is called as your fiscal policy, right? In case of your monetary policy, there are two variables which is very important, what we called as the economic policy lag. There is a lag variable, there is a lead variable. What do you mean by lag variable? For example, you might be heard about the direct instruments of the monetary control. How this Reserve Bank of India, by exercising the monetary policy instruments, they are controlling the expansion of the money supply. They are controlling the expansion of output, prices, exchange rate, or anything else, or how they control the inflation. So at that point of time, they are actually exercising either the repo rate, reverse repo rate, or CRR rate, or your SLR rate. Now, if you are taking an action today that you would like to curb your inflation and you want to increase your repo rate. What is repo rate? The rate at which the commercial banks are actually borrowing from the Reserve Bank of India. So you would like to increase that repo rate so that what will happen? There will be a tight monetary policy situation in the country. So in this case, the moment you are increasing the repo rate, and it will create an impact in the banking sector in terms of the consumers and other economy, it will take some time. So you cannot say that the impact of the output is completely not dependent upon the current time period at this point of time. So that is why in your economics, quote and unquote, there are two kinds of variable. One is called as a lag variable, another is called as lead variable. Even if in the monetary policy parlance, it is called as the inside lag or the outside lag. What does that mean? What is the policy rate in terms of the structural change the government is implementing as a policy authority? and its impact on the economy, it will take some time. For example, if you are telling that growth is a function of money supply, that means money supply is impacted to the interest rate, and if you are changing the interest rate, what will be the impact on the growth? It will not be sudden and spontaneous. It will take some time. So that is why if you are modeling your growth which is impacted through this kind of money supply and interest rate, you cannot taking actually the current time. You have to take the lag time. Likewise, some of the policy designs, whatever you are taking it today, after 6 months or 12 months, it is going to be impacted. It's called as the lead variables. So whenever you are going to deal with this kind of lead and lag instrument, in case of the classical linear time series model, classical linear regression model, it is not possible. That is why, to your consumption, time series is always expressed in terms of a autoregressive format or a moving average process. So autoregressive or the moving average process is part of the time series. For example, you are explaining everything in terms of its own lag past. Okay, if you are doing a interest rate modeling, you are saying interest rate of today is a function of interest rate of yesterday, interest rate of before 2 days, interest rate is a function of 3 days before. So you are explaining in an autoregressive format. But in your classical linear regression model, we never talked about actually in your autoregressive format or your in terms of your moving average process. That is only possible in case of the time series model. And the next silver line of difference between your classical regression model and your time series model is that time plays a very important role. Time itself is a variable. Time is a trend variable. That trend variable can be a stochastic variable, can be a deterministic variable. So how you are explaining time itself is a explanatory variable and all. That is why time plays an important role. That is why it is called as time series econometrics. And apart from that, why time series econometrics actually? Time series econometrics overcome a limitation of classical linear regression model, what it is called as a spurious regression or a nonsense regression. It is not my jargon. It is the econometrics parlance. Let us try to understand that. What are the beauty of time series, or what are the advantages of the time series econometrics over our classical linear regression model? So in this case, how do you define a spurious regression? So spurious regression is nothing but it is a relationship between a set of variables where one variable assumes the dependent variable and other variable is other variable set is called as your explanatory variable or independent variables. So whenever you are regressing the dependent variable on the independent variables, you might end up with two conditions. What are these conditions? Either your R square, what is R square? The goodness of it. It might be sufficiently large, around 80 to 90% or 99%, and you have only few T statistics confidence level, few T statistics significance level. And it is other way around also, it is correct. What is that? You may get high T statistics value but a very low R square. So in this case, what will happen? That means these two cases are the specific case for your spurious regression. No, I'm just talking about the different facts. I'm not showing any slides, just to put the basic that why time series econometrics and what are the different limitations that time series actually overcross in terms of your classical linear regression model. Why should we be bothered about the time series model? That is what I just would like to go ahead first. So in this case, what happens? The spurious regression or the nonsense regression was actually overcome by the time series econometrics. And the spurious regression are very, very important. For example, in case of the classical linear regression model, the moment you are actually ignoring the time, this kind of spuriousness is actually takes an important role. So from the spurious regression, if you are encountered with this kind of conditions, and if you are generalizing that kind of sample in terms of the population, it will give you a biased result. So that is why time series econometrics has developed as a separate discipline within the econometrics umbrella. And second thing is that how the time series is actually overcoming this kind of problems. Because nowadays, if you look at any kind of indicators or any kind of analysis, let us say macroeconomic variables or the macroeconomic fundamental factors, starting with your money supply, output, prices, interest, exchange rate, volume and receipt of exports, imports, current account, deficit, surplus, capital account, your balance of trade, your trade deficit, whatever you take, everything is available at with a regular time interval or with a frequency of your annual, monthly, daily, quinquennially, decennially, and all. Everything is a time series data. Now, if you'd like to pondering about, you take all these variables and try to fit in your classical linear regression model, and the same variables you treat in terms of the time series problems, and you compare both the results. Then you will realize that what is the importance of the time series model whenever you are actually violating or ignoring the time.
Excuse me, sir.
Yes.
Sorry for the interruption. Sir,
Yeah.
actually slides are not visible.
I have not gone through the slide. I'm still talking about how the time series is actually important than your econometrics, classical linear regression model. I will come to the point whenever the time series will come. Okay.
Thanks.
So that is why your time series model plays a very important point, very, very important role or a pivotal role from the time point of view. So how this time series overcome this limitation? It overcomes the limitation while you are going to deal with a time series. How to define the time series? The time series variable or the information which is available at a regular time interval, or in terms of your mathematical parlance, it is called as a continuous distribution or continuous curve without removing your hand. Now, what are the issues? Let us say the stock market. Have you heard about the equity market or the stock market? We have trading, we have mutual fund, we have investment, we have so many, we have a well-developed financial market. Every day the newspaper is actually hitting the headlines. The market has nosedived by 1,000 points. Indian market is on the bull run. The Sensex is the parameter of economic growth. And because of the cut of the Fed fund interest rate, market has down by 1,000 points. You might have aware of many kind of information. Yeah, please tell me. Gurung, any doubt? You are raising your hand. No? Okay. You are telling something, Gurung?
PPT is not showing, sir.
I have not shown my PPT. I'll come to the PPT in few minutes. Just bear with me. Let us try to understand the basics. Why we should work on the time series econometrics. So in this case, what happens? The time series variable is which is available across the time at a regular time interval. So all these equity market or the financial markets, they're actually working for the 5 days in a week. The trading days is from Monday to Friday. So on Saturday, Sunday, you do not have the data. But if you go for the currency market or the foreign exchange market, because of the geographical jurisdiction in such a way that it is a 24/7 market. And if you look for any other macroeconomic indicators, it has also 7 days in a week. Now, can anybody tell me whether this 5 days in a week, which is available for trading, is it a time series data whenever you are losing two data? And how you are going to deal with this? If the definition is saying that it should be available at a regular time interval. What people used to do nowadays, while you are collecting and compiling the different kind of information from the different sources, what you are going to do that, what you are going to find in across or the against the dates, you have the different kind of informations. some information. For example, take the example of the stock price and the currency market. Currency rate, exchange rate is available for the 7 days, but the stock price is only available for your 5 days. Let me give a simple example from your international trade parlance, a novel theory called as portfolio balance approach. Have you heard about this portfolio balance approach? A
Yes, sir.
stock-oriented approach. Let me give you economic logic. So what we used to do in case of your classical linear regression model, there is a theory. You are collecting the information, you are checking the quality of that information, then you are using the decision sciences tools, and after that you are doing the modeling. Let us say the stock-oriented model, it gives more emphasis to the capital account. I hope all of you are aware of what is capital account. Capital accounts is dealing with the volume and exports of the foreign investments in terms of private placement or in terms of the equities, in terms of the financial assets. However, current account is dealing with the volume and exports of your volume and receipts of your exports and imports, right? So what happens in case of India, we do not have the capital account convertibility so far. So what happens over here? The model says that it gives more emphasis to the capital account, not the current account. And what is the logical deduction over here? If there is an exogenous increase in the stock price, I'm coming to your macroeconomic logic in terms of your international finance model or trade model, which is called as portfolio balance approach, being developed by your Branson and Frankel. So what they say? If there is an exogenous increase in stock price, it is the model developed in the 1873. Okay. So what this model says, the model says that if there is an exogenous increase in the stock price, what does that mean? Whenever there is a boom, for example, in case of the Indian scenario, the Sensex is 1978-79 equal to 100. Now today we have actually reached around 80,000. So 5,000 has reached to 80,000. So there is an exogenous increase in the stock market. Even there is a bull run. The market is growing in a progressive mode in such a way that no negative news is actually affecting at this point of time to the Indian market, equity market. So what happened? If there is an exogenous increase in the stock price, what will happen? Your demand for money will increase. And you all know by applying your macroeconomic logic that if demand for money will increase, your short-term interest rate will go off, right? So if the short-term interest rate will go off, what will happen? It will attract more foreign capital into your domestic countries. Why? Because if the Fed fund rate is actually 2% and your domestic interest rate is actually 6%, there is a 4% margin, 4% gap is there. So that 4% is attracting more foreign investment to your domestic economy. Of course, it depends upon your political stability, macroeconomic stability, and financial stability. But especially the higher margin of the interest rate differential is an indicator to attract the foreign investment into the domestic economy. Now, what happens? If the foreign investment comes to your economy, what they will do? They have to surrender their foreign currency to the Indian commercial banks or the Indian public sector banks. What will happen? So they will surrender all their foreign dollars, US dollar or European euro or your Japanese yen, whatever. They have to surrender to your bank. After your current account convertibility in the 1998, now none of the Indian public sector banks need RBI's permission to accept any kind of currency. They are free. 100% they can accept. There is a free entry and exit in the market. So Indian banks are actually purchase this kind of foreign currency at a lower rate and they try to sell the Indian rupees in terms of a higher rate. What will happen? The exchange rate started appreciating. You have started at the stock price, you have ended at the exchange rate appreciation. In between, you have demand for money, interest rate, and you have more foreign investment, and that has attracted the exchange rate to appreciate. And after the exchange rate appreciate, what will happen to the export-led companies, or what will happen to the import-led companies, or what will happen to the growth? I'm not getting into those. So let us take into this. Let us say this kind of theoretical economic logic you have, and you would like to build a model. So So what you are supposed to do? So you all know that stock price is a time series variable, exchange rate is a time series variable, net inflows of the foreign investment, that is also time series variable, interest rate is also time series variable, and money supply is also time series variable. But here, stock price is only available for 5 days of trading, interest rate is available all across, and exchange rate is also available for the 7 days. Now, while you are collecting the information, because you need a specific dates where all the informations are available. So are you going to miss 2 values of the exchange rate because 5 days trading of equity is available? Or are you going to extrapolate or interpolate the stock price to in order to have 2 values for your Saturday, Sundays? Or you are going to match the dates and remove all the information wherever all the variables are available? All 3 options are open for you. Now, whatever the option you use, it has its own limitations. If you are exercising your first option, that you will lose 2 information of the exchange rate and make it compatible with the 5-day stock price, where only you are considering the 5 exchange rates, that is also wrong, because the time series definition is actually losing over here. If you are doing the second option, that you are consistent with the exchange rate and bringing all these kind of stock price, and you are using a Saturday, Sunday dummy variable, or you are extrapolating or interpolating depending on that trend, there also you are doing a biasness, you are bringing the biasness. And third one is that if you are bringing all the variables in one kind of matching data set, you are losing a lot of information. So whatever the things you are using, there are certain specific limitations. And in the time series econometrics, whenever you are collecting all these information, as I say, data absorbs information, and we need that information. For example, if you are saying that today's stock price is 80,000 of Sensex, that means 30 companies from 1978-79 to till 2024, whatever has happened, on an average, the price is showing that all the information is absorbed by this 80,000. And what you are doing, you are extracting that information to do your money. Yeah, can I take a couple of questions? Many people are raising the hand. Vishwasri?
Yes, sir.
Yeah.
Sir, suppose if 7 to 8 years data is missing, can we fill this data by applying interpolation?
You can, mathematically, yes. But it all depends upon what is your objective and what you would like to extract. And what information and what is the variation, whatever the data variable you have created through your either extrapolation or interpolation or the linear trend or nonlinear trend, whether it is compatible or not.
Yes. Thank you, sir.
Anybody? I'm not checking the chat box because it is distracting to me. So you can directly raise your question if anybody has anything. But does it make any sense? Are you getting my point, what I'm saying? The challenges while dealing with the time series model or the compiling of the data? Is it clear?
Yes,
to all
sir.
of you? Yeah.
Yes, sir.
Now here, what happens? In one way, we are talking about the definition. In other way, we have the challenges and what are the possible solutions while dealing with this kind of time series econometrics. So what I said, data means information. At any point of time, we should not do any kind of treatment or any kind of postmortem analysis which can throw the information out of this data. Because if the information is thrown, what is there for you to extract? That is why information content in terms of that data, it is very, very important. Now, while you are dealing with the time series econometrics, as I said that each of the variable is actually measured against the time. So you have GDP, you have output, you have prices, you have employment, you have unemployment, you have inflation. There are different variables are there. Output, prices, exchange rate, so many. Whatever the variables you can think about. So each of the data, whenever you minutely observe, what is the scale, what is the size, what is the unit of that data. Nowadays, Whenever I'm going through different papers as an editor of the different journals, I often encounter, just for the sake of the simplicity of the quantification that paper is required, people are doing actually the quantification. And how it is visible? Because you have developed an eye contact with that data information. Let us say you are doing a modeling, you are doing a quantification, you have growth, you have inflation, you have unemployment, and you have, let us say, consumption data. So growth is in terms of percentage, inflation is a rate, unemployment is a rate, and you are taking money supply, which is in terms of absolute number. There are different units. So while you are doing the modeling and try to explain or analyze each of the number, can you forget the units over here? That is why in which method you are going to do the what kind of treatment. For example, where you are using correlation, where you are using canonical correlation, what kind of missing value treatment you are doing, what kind of extrapolation you are doing, what kind of interpolation you are doing, how many unitless variable are there, how many unit variable are there, how many absolute variable are there, how many relative units are there. All things actually matters a lot for this kind of measurement. By simply giving the information to the computer programming in terms of the Stata, Python, R, or SPSS, it's not going to resolve your problem. That is why statistics is very much abused nowadays. We should understand what we are expected to do, what kind of expected sign we are expecting. Because computer can quantify the numbers, but computer cannot establish the relation and cannot draw the inferences for you. That is why you have to exercise your brain. You have to exercise your modeling skills. What variables I'm taking, you need to understand your information. You need to understand your data. You need to understand your variables. You need to understand your time frequency. You should understand your frequency domain. And after that, is there any kind of treatment is required for this data? Is there any kind of, what kind of treatment? Whether I have to go for the smoothened data, whether it is exponential smoothing, or whether it is the normal smoothing of the data, or can I do any kind of transformation like your log-log transformation, lin-log transformation, or any kind of unit transformation. Why we are doing that? To bring all this information into a specific platform, so that the data should be ready for the model. You understand? Without that, you cannot actually build a model and you cannot generalize that result. But without this treatment, if you are directly going for that, what will happen? You are going to provide the information which is not satisfying any kind of properties, what we called it as a blue. For example, Bayes linear unbiased estimator. People are taking the different sample. They are actually, by drawing the simple random sampling from your most of your primary data or qualitative data, you are doing a questionnaire survey, right? You are drawing the different questionnaire. It might be randomly drawn or stratified drawing or convenience sampling or purposive sampling, whatever you say. Have you ever asked, whatever the sample I have drawn, is it actually really random? Is it qualifying all the characteristics of the random sampling by simply saying random? That itself is creating a problem. Many of the questions while doing the research ethics or the value evaluation, I used to ask the many scholars, how do you justify that your sample is random? Right? For example, to substantiate this, your census population, it is 1% of your 148 billion of the population. Is it random? Is it sufficient to generalize the entire population and all? So that is why the random characteristics while designing the questionnaire, how much random it is, how stratified is that, within that stratification, whether random sampling is there, you need to evaluate that kind of randomness before you are generalizing this. So that is why a lot of questions, for example, if a real number set 1 to 10, you are doing the different kind of pairing 1, 2, 2, 3, 4, 5, 6, 7, 8, 9. Is it random? Is it fulfilling all the random characteristics? So people are very conveniently using it is my random sampling and all, but it actually does not fulfill all the randomness characteristics. And whenever you are working on this kind of sampling and deriving the information and generalizing for population, for policy making and all, it loses its authenticity and it is ability to interpret something. That is why there is a huge gap between the research, academic research finding and the policy implementation. There you need to be very careful. Likewise, in case of the time series regression, time plays an important role. Data absorbs all the informations. Whenever you are dealing with a different kind of variables on a particular theoretical framework and all, how you are going to deal with that information. Whether the scale wise, the size wise, the data transformation wise, data characteristics wise, data feature wise, everything is appropriately built up for the model to be exercised. What is the economic logic? What kind of expected sign you are expecting? What are the previous empirical findings are available in this kind of relationship? Why you are getting a different relation? Whether the same relation with the log transformation or without log transformation, whether the same information with a constant or without a constant. To your surprise, nowadays, different models, whenever you have a specific variables or variable set to establish some kind of relationship, and if you are not getting the statistical significance, for example, to substantiate that, let us say adequately explanatory variables are not explaining the average change in the dependent variable. Let us say you are saying that your growth is a function of trade openness, consumption pattern, advertisement expenditure, employment generation, and some other variables. Let us say all these explanatory or independent variables are not adequately explaining the average change in the GDP. Whenever you are actually dealing with a constant, and the moment you drop that constant, some extent your variable or variability in terms of the beta 1, beta 2 associated with your explanatory variable, they are increasing. I have seen many tables. People are actually drop that constant, getting a adequate value of R square and other explanatory variables, but they are interpreting in the same way the way we are doing the ordinary least square with your constant. So there it is a problem. What is the problem? So if you look at the econometrics parlance, one regression we call it as the regression through origin. Another regression without origin. What does that mean? Your entire classical linear regression model starts with where your intercept is starting with the y-axis. Correct? And whenever, at what point of time intercept will start from the 0? Whenever constant is equal to 0. So you cannot interpret the regression without origin, which is starting from your y-axis, and the regression which is starting from the origin. They are both different interpretation altogether. Likewise, some of the variables we are taking as a log and some are without log. Some variables are actually in the independent variable, they are converted into the log, and dependent variable is without log. But we are interpreting in the similar way. And in fact, we have seen when both the variables in both the site LHS as well as the RHS, both are converted into the log, that has to be interpreted in terms of the elasticities, percentage. But there also we are interpreting 1 unit change in this, another unit change by that. So this kind of abuse has to be restored back with the proper thinking that what you would like to examine, what is the question you post, what kind of information you have taken, whether the sample is sufficient enough to extract the information which can be generalized for the population, and what kind of quantitative treatment you are giving, and what logic you are applying, what decision science tool has applied, and what information you are extracting. So to avoid this, so if you are not treating all these things and directly getting the result, this is called as spurious regression or nonsense regression. You are going to get some information at the sum value of your R square, T statistics, and each of the coefficient, whatever the information you give to any kind of package. But that does not have any meaning. You cannot actually generalize that sample result for the population. So in that case, the time series plays an important role how to avoid this kind of spurious regression or your nonsense regression. How? Through a treatment called as unit root test. It is also called as stationarity and non-stationarity. Let me put it in a very common parlance to understand this. As I said, what is the difference between the classical linear regression model and time series? You said all the time series regressions are actually expressed in terms of a autoregressive process. For example, if you are telling that GDP of today, I'm not taking consumption, expenditure, agriculture, industry, service, export sector and all. I'm saying GDP of today is a function of GDP of, for example, let us say GDP of this year is a function of previous year, 2 years before, 3 years before, 4 years before, 5 years before, so forth and so on. That means I'm explaining only one variable which is a function of its own lag past. I'm not including any other variable. For example, stock price. Sensex of today is a function of Sensex of yesterday, 1 day before yesterday, 2 days before yesterday, 3 days before yesterday, so forth, so on. So it is an autoregressive process. The name itself is defining. The variable is a function of its own lag past. I'm not considering any other variable. So in the time series regression, you are going to deal with all autoregressive format. But in the classical linear regression model, you have a y variable, you have a x variable. Y is a function of x. That is the difference. So what happens? Why it is called as unit root or the stationarity? Unit root means it is called as a lag operator. Let us say GDP of this quarter is a function of GDP of previous quarter. Okay, if you are saying GDP of current quarter is a function of alpha, alpha is nothing but your intercept plus GDP of previous quarter. That means the lag operator is 1. To the current year GDP is a function of previous quarter's GDP. If you are taking another quarter GDP, it is called as lag operator is 2. So the lag operator root power is 1. That is why it is called as unit root. That is why there is no other term is used. It is called as double root or triple root and all. So you need to understand why it is called as unit root with respect to your lag operator, whether the root power is 1 unit. Now, why unit root and how time series actually overcome this kind of spurious regression at all? Let us try to understand. So the definition, if you go for any kind of standard textbook, what the definition says, a stochastic process is said to be weakly stationary if its mean, variance, autocovariance at different lags is time independent. So before understanding this, let us try to understand what is a stochastic process. What are the characteristics of a process to be stochastic and what are the process to be deterministic? In your classical linear regression model, whenever you are defining anything, let us say y is equal to alpha plus x beta plus u. A simple regression model. What does that mean? Y is my dependent variable. X is my independent variable. Beta is the parameter or the coefficient associated with the x. plus we have another u. That u is nothing called as error term. How to define this u? U is nothing but y minus alpha minus beta x. That is what u's value. What we interpret in terms of the econometrics. Apart from, whenever you are defining y is a function of x, apart from the x, if any other things which is available in this universe, which can impact y, that will be being taken care by the u. That is why you called this the error term. And you are assuming that error term is normally distributed with your mean and unit standard deviation. Because each of the error term has to follow some distribution. Then only you can calculate your alpha and beta. And after that, you are applying your OLS to minimizing the square error term to get your optimum value of alpha and beta. That's what you are doing in case of your OLS regression model. So this U is a stochastic process. This U is a random variable. This U is a disturbance term. And this U, in case of a time series regression, whenever you are saying that GDP of current quarter is a function of GDP of the past quarter plus a U, that U is also called as a noise term, a disturbances term, a random term, a error term, which is actually assumed to follow a normal distribution. Which normal distribution? Standardized normal distribution of zero mean and unit variance. Why it is a process is stochastic? Because it is random. How to define the random? The change is random. Your mood is random. Your learning pattern is random. Right? Random in the sense, let us say if I will make a statement, depending upon whatever the information is available today, you cannot predict at what price the market or the stock market is going to open on the Monday. That means the market price is completely random. You don't have any information. There is no such past information available, readily available in your hand. By exercising that, you can say that no, price will open at this price, open on Monday in this price. You can verify that. Let us say today, whatever the price in the Friday at 3:45 when the market closed, whatever the price of the different stocks are actually closed, you note down that closing price. That closing price should be the opening price in the Monday when the market opens at 9:40, but it's not happening. That means market is random. Our mood is random. Our reading pattern is random. Why? So that means the change is unpredictable. What does that mean? The future values is not dependent upon the past information, whatever is available. That means your historical regression model as a predicting model is not possible if the market follows the random one. So that is why a stochastic process, whenever I'm talking about a stochastic process, it is also related with a, you might have heard about, nowadays there is a separate decision science tool has developed, what it is called as a econophysics. We are bringing the physics terms or physics computation tools to the economic theories in order to quantify that. What are those? For example, your equilibrium concept, it has come from the physics. Likewise, your wavelet, your Brownian motions, Ito's lemma, stochastic calculus, all these concepts are actually brought from the physics over here. So that is why Markov process, geometric Brownian motion, random walk model, noise, or error term in your econometrics, they all are actually together in terms of explaining that. So that is a stochastic process. Process is completely random. Geometric Brownian motion, everything the same concept. You cannot forecast the future price based upon the historical information, whatever is being available till today. That means it is completely stochastic. It's completely random. So in this case, what happens? You are defining a stochastic process is called to be weak stationary if its mean, variance, and autocovariance at different lag should be time independent. What does that mean? If you are taking this kind of series, calculating the mean, variance, and autocovariance at different point of time, you are expected to get the same time, same mean, same variance, and same autocovariance at different lags. Then only it is called as your stochastic variable is called as stationary. If it is not time independent, it is called as non-stationary. There are different concepts are actually related with this same statement. Some people are saying long memory test. Some people are saying that whatever the short-term deviations are there, that is going to converge in the long term. There are different kind of research, but let us try to understand from a unique or common man's perspective what this stationarity and non-stationarity makes for us and how it overcomes the limitation of the spurious regression, which is stemming from the classical linear regression model. Okay, so in this case, what we understood, a stochastic process is said to be weakly stationary if its mean, variance, and autocovariance at different lag are time independent. I'm going to prove that by taking a series and by showing it how it is actually happening. How do you get to know that? Let us say you have taken the trade deficit. What is trade deficit? How to define? Whenever the volume and receipt of the exports and the volume of receipts and volume of receipts of imports, they are actually misbalanced, whether the export is higher than import or import is higher than export. So trade deficit means import, the volume and receipt of imports is greater than your volume and receipt of exports. So you are taking the trade deficit over a time period, let us say from 1970 to the 2024, and you have simply plotted that in a two-dimensional coordinated plane with a line graph. So by exercising your eyeballing exercise, by observing the pattern of that series, if you are finding a trend, time itself is a trend. Each of the variable is actually associated with a trend. Trend can be an upward trend, trend can be a downward trend. So if you are finding either an upward trend or a downward trend in any series that has come across your way, then you can say that the series is actually non-stationary, whether the trend is upward or the downward. Despite of its movement, upward or the downward, if there is a strong trend involved, through your eyeballing exercise, you can say that the series is actually non-stationary. What does that mean? If you are taking the different sample or different time component you have to here and calculating the mean, variance, and autocovariance at different lag, that means it is not time independent. If that is the case, you can call it as a non-stationary series. So most of your time series model, except one technique, is actually dealing with all the stationary variables. So if you have a series of non-stationary variable, unless until if you are not making into the stationary, you cannot apply any kind of time series model into that. That is why it is very important that each of the non-stationary variable has to be made to be stationary. Otherwise, it does not make any sense for you that what is the meaning of that. Okay. Now, the second thing is coming actually the seasonality. You must be aware of that. What is seasonality? Why seasonality? Where do you see the seasonality of any kind of variable? Can anybody tell me? In case of GDP, seasonality is there. In terms of agricultural production, seasonality is there. In terms of employment, seasonality pattern is there. In terms of consumption pattern, is there any seasonality is there? For example, in case of the COVID-19, the consumption of the hygienic products has increased. Is it because of seasonality or because of the pandemic? Now, the health ministry is giving the awareness of your monkeypox as a health hazard in terms of that. So people will use more consumption basket as the hygienic products. So you see a seasonality. So now tell me, if the seasonality is available in terms of any kind of variables, and without treating that, if you are taking care of that model, what will happen? Anybody? If the seasonality will be there, you are not treating that seasonality, you are directly taking into a classical linear regression model. What are the problem you are going to occur? What are the problem you are going to face? Or what problem it will be triggered that you are expecting? Anybody? No?
We may get
So-
high RCR value.
Okay, anything else?
We cannot observe accurate value.
You cannot observe?
Accurate or real value.
Anything else? Any value added answer?
Sir, seasonality can produce a fluctuations in a trend.
Okay, let us try to understand what is seasonality, why it occurs, what are the issues, what are the challenges, and what are the different unique characteristics of the seasonality. This is very important before getting into the model. So how the seasonality you are actually you are explaining? So your seasonality is nothing but it refers, or it can be explained in terms of a predictable or recurring fluctuation in a time series that occur at a regular time interval due to seasonal factors. What are those factors? These variations are typically associated with your time of year, such as your months, quarters, or even weeks, and are driven by the factors like your weather, holidays. For example, in case of your unemployment, we have seasonal unemployment, we have frictional unemployment, we have disguised unemployment, right? Or in terms of different kind of cultural factors, heritage factors, social factors, demographic factors, regional specific factors, anything that can matter for this kind of seasonality. Okay. What are the key features of this seasonality? The one is called as regular pattern. Why I'm discussing all these things, why the econometrics models, why the statistical models, they could not perform to their ability or capability what we're actually losing while understanding our basic concept into it. I don't mind if we are consuming the timing. Maybe in another Friday or Saturday, I can come for the hi-fi modeling, whatever is available in terms of the recent phenomenon. But I just would like to explore my first session to make you aware that what are the different patterns of the seasonality and how you are going to incorporate this kind of changes into your model. That is more important than any kind of modeling, because modeling exercise is just a clerical job. You take the data, you get into the packages will give you the numbers. But what that number makes sense for you or not, that makes a lot. And what is behind that package, how they are actually generating the number, how they are treating this number, that is more important than any kind of numbers. Yeah, so that is why your key feature of seasonality is nothing but it is called as a regular pattern. Why this regular pattern occurs? Because your seasonality repeats at consistent intervals, like your daily effect, weekly effect, monthly effect, or yearly effect. In the stock price from Monday to Friday, there is a day into week effect, there is a month into year effect, there is a year into the whole effect because of the seasonality. What is a day into the week effect? Especially while the market will open on the Monday, it will open until a low note. On Tuesday, Wednesday, it will go off, and in the Friday, it is strengthened, and again, in the Monday, it is come down. Sometimes you might have heard about Black Monday, Black Friday, all these things. It is called as day in week effect. Week in month effect, month in year effect, likewise. For example, in case of the GDP, agriculture is directly a fair weather friend of your weather, monsoon. For example, despite of a huge rainfall, you might have seen in case of eastern countries and the western fields, they don't have the sufficient waterfall so far to cultivate in this season and all. In other ways, it is flood and all other, but the cities are actually devastated. So now, because of your rainfall, normal rainfall or the normal weather season, your agricultural production is affected. So that is also a seasonal pattern. So that is why the regular pattern, or maybe in terms of, let us say, natural gas, in those who are actually working on the energy, how the US, UK, or the Middle East, they will get to know that how much natural gas consumption is required for the summer, winter, or the rainy season. Why? Because natural gas is with respect of your heating degree days and cooling degree days. What do you mean by heating degree days? The average temperature during the summer is this much. How each of the days temperature is actually deviated from your average normal temperature of that day, and they used to calculating the total heating degree days. If the total heating degree days will be more, your consumption of the natural gas is required more because you need to take care of the temperature. Likewise, cooling degree days in terms of the winter. What is the normal temperature and how each of the temperature is coming down to how much? So they used to calculate that cooling degree days. So if the cooling degree days will be more, then your natural gas consumption will be more because you have to heat your temperature and all. So that is why that is called as intertemporal change. So the seasonality, while working on any kind of variables, they play important role, and what kind of frequency you are taking into that. So that is regular patterns, a key feature of a seasonality. The second one is called as your fixed periodicity. What is that? The length of a seasonal cycle is fixed. That is why if a variable is with the seasonality, you are going to get a specific pattern out of it. Looking at that eyeballing exercise, you can say that whether the data is with the seasonality or it is a non-seasonal data. Okay. So meaning that the pattern occurs at the same time each year or the period. For example, the consumption of the sugar from August to December, it increases. And after that, it will come down. Or maybe in terms of your purchase of the wealth, in terms of the equity of the shares, if you take from the October to Martin Luther's Day in the January, the prices of the shares will increase. So there is a specific pattern is involved over here. Okay. That is why, for example, a time series with a monthly data, seasonality would be expected to reoccur in every 12 months. So there is a specific periodicity is involved in that variable to capture that kind of seasonal pattern. For example, consumption of your beverages in terms of the cold beverages. In the summer, if it is a crunching summer, if it is increasing, your beverages, buttermilk, all this consumption will increase. And if in the winters, your consumption of the tea and coffees are increasing. So there is a periodicity involved in this kind of seasonality pattern. The second one is called as your impact on forecasting. Whenever the seasonality will be there, generally we are using the different kind of tools in the economic logic or economic theory to forecast their behavior. How a variable is behaving today and how there is going to behave in the near future, what kind of relationship they have, whether that relationship is linear, non-linear, or any other relationship. That is what we are forecasting, right? You are predicting. We call it as a predictive analytics through your regression and all. Or you are forecasting your GDP before the budget for allocation of the resource into the different sectors. Government used to do that by doing the different field visit in terms of agriculture, industry, manufacturing, service sector and all. How the forecast? Can anybody define what do you mean by forecast or the prediction? How to forecast? How to define forecasting?
Sir, it's a process of predicting the future values based on the previous value.
Okay. In the time series in the random model, what we said that a process is called to be random or stochastic whenever there is no historical information which is available with you that you can extract to predict your future. So that means if the future is not dependent upon the historical information, how to forecast? You understand my question, right? So in this case, the founding father of forecasting is actually Angel and Granger. You can read that paper, Angel Granger's forecasting. Angel Granger, because of that forecasting technique, was also given the Nobel Prize. So whenever you was taking a session for all these students, the first bench of the students, they have asked how to define the forecasting. What is the prediction? What is a foretelling? What is Angel Granger's answer? Let me quote Angel Granger in quote and unquote, in the passive voice, that an astronomer can predict the movement of the moon at 11:30. But at the same point of time, the astronomer cannot predict of his or her own daughter's movement. And that is what forecasting is. It is his direct speech. It's not my speech. What do you understand by that? That means randomness plays a very important role in the forecasting. What is it? An astronomer can predict what is the movement of the moon at 11:30. But at the same point of time, the astronomer cannot predict his or her own daughter's movement. That means something is missing over there which is not available. That is why you could not predict what could be the tomorrow's stock price. You could not predict what could happen to your mutual fund values. You could not provide what will happen your retirement saving depending upon current investment. Had you been done that, you would have been a millionaire or billionaire. That means some randomness is there where you cannot extract the historical past information to predict about the future. That is why the prediction is not in your hand. So while there is a seasonal pattern which is associated with some of the variables and you are using that for forecasting, that is why understanding and accounting for seasonality is crucial in the time series forecasting whenever you are doing any kind of univariate forecasting or bivariate forecasting. And ignoring seasonal patterns will lead to your inaccurate forecast. It will be with some biasness. That is why seasonality plays a very important role. Now, if the seasonality is there, how you are going to deal with that seasonality, or how you can deseasonalize it, or how you are going to adjust that kind of seasonality. So that is why to analyze or the underlying trends and cycles in data, the seasonal adjustments often made. Even the census population in the US and all, that has also a seasonality feature. That has to be also deseasonalized. And there are different methods altogether to deseasonalize the data. You have X11 method, you have X12 method, you have X13 method, you have ARIMA method, you have moving average method, you have Tranto procedures. How to deseasonalize or how to eradicate this kind of seasonal patterns from the data to make it a seasonally adjusted series. Okay, so that is why it is very important that if a seasonality involves, you need to deseasonalize the data. You all need to understand all this procedure, how to make a series deseasonalize. So X12 census method, it is a very recognized procedure. Now X13 method has also developed. How that is deseasonalize the data and why that seasonality fluctuation is there. If you look at any pattern of any variable and putting that in a two-dimensional coordinated plane, the kind of trend you are getting, and if you are getting any kind of seasonal pattern, while applying this kind of deseasonalized procedures like your X11, X12 or X13 method, what happens? It segregates the series into 4 parts. One is called as trend part, cyclical part, irregular component, and finally through a additive procedure or through a multiplicative procedure. Additive procedure or multiplicative procedure, they are providing a deseasonalized or a seasonally adjusted series. So your seasonal procedure or seasonal method, it segregates the series into a trend path. That trend might be upward trend, the trend might be downward trend. Second one, the cyclical part. What kind of cycle it is? And that makes a lot of sense for you. Whether that cycle is counter-cyclical to your economic cycle, whether that cycle is pro-cyclical to your economic cycle, or that cyclical is actually mirror imaging to any other associated series. And within the cyclical, what are that irregular component? What we are calling it as the noise term, like your radioactive lines, zigzag terms. People used to capture that kind of cyclical movement. There is a cyclical research division is actually available. Can you capture that kind of irregular component and can predict whether that cycle is going to be repeated? Most of your IMD, Indian Meteorological Department and all, they are using this kind of models, whether a cyclone is going to be predicted in the next 15 minutes, how it is moving and all. So it is called as a cyclical research. How irregular cycle is that? Can I just capture that cycle and my focus is only on that concentration of that cycle? Can I predict that how much time on an average it will take that the same cycle is going to be repeated? So what this kind of seasonal methods are actually doing, they are actually dividing the series into many parts. One is called as trend part, cyclical part, irregular part. Now take the example of trade deficit. You are expecting a lot of negative figures over here. So here, if you are applying that kind of X12 method, as the many of the figure as negative, at what point of time the figure will be negative? Whenever the input is greater than expense. So at that point of time, to give you a seasonal adjusted series, additive procedure is not adequate to give you a seasonal adjusted series. You are going to get an error term if you are applying that additive procedure. So there you have to apply the multiplicative procedure to get your seasonally adjusted series. What are the examples of the seasonality in the time series? For example, retail sales peaks during the holiday season, like your Christmas, Diwali and all, or disposed holidays. Second one is your tourism. For example, higher number of during in the summer, winter and period, depending upon the different kind of regional zones. Your agriculture, cash crops or the crop yields due to, so the seasonality due to the planning and harvesting cycles. Or your weather patterns, as I have said, in case terms of your cooling degree days and heating degree days. And seasonality in the time series plays a very important role, and how the various techniques are used. Some modelers, they are actually incorporate the seasonal dummies. Summer seasonal dummies, winter seasonal dummies, or your autumn seasonal dummies. So seasonal dummies are nothing but including the dummy variables for each season in a regression model. But you should be aware of the dummy variable trap. How many seasons, how many seasonalities. The second method is also called as, another method is called as seasonal differentiating. What does that mean? Applying the difference to the data at seasonal lags. For example, differencing at 12-month lag or for annual seasonality, differencing on 30 days, differencing on 7 days, differencing on 3 days, or differencing on the 5 days if those are working on the financial data where the trading environment is available for the 5 days. So that kind of differencing series or moving average. For example, if it is a 5 days, first take the 5 days and calculating the moving average, then leave the first, then come for the next 5 days, then leave the second one, then coming for the first one. So 5 days. Likewise, this is called as a rolling average. That also you can de-seasonalize. So that is why understanding seasonality helps you for the business and policymakers and economists to make the informed decisions by predicting the periods of your high demand, adjusting the supply chain operation, and planning resources allocation, where you can derive the different kind of logical inferences which can directly relate to your policy decision. Now the question arises, whenever you are actually dealing with the time series variable, whether first you have to take care of the seasonality or you have to first take care of the stationarity. Because both the seasonality and the stationarity are important for the time series models. So how do you are going to handle this? You understand? Whether I should go for the seasonality first or I should go for the stationarity first. It's a kind of paradox. And at the same point of time, the challenge is that what we have started, data throws a lot of information out of it. Because information plays an important role to capture this kind of information, capture this kind of inferences. So the moment you are going for the seasonality, you are going to de-seasonalize. That means you are throwing some of the information. Again, you are coming to make that variable should ensure that it is stationarity. Again, you are going to make it stationarity, you have to difference. Then again, you are throwing some of the information. So whatever the left is there, from there you have to extract the logical inferences which can be generalized for the population. Now the question arises whether I should go for the seasonality or I should go for the stationarity. If you look for any kind of empirical papers, there is no such near unanimity on this, whether we should consider for the seasonality first or we should take care of the stationarity first. Let us try to evaluate this aspect before getting into the time series model. We have already discussed that what do you mean by stationarity? A stochastic process is said to be stationary if its mean, variance, and autocovariance are different lags to be time independent. If it is not there, what you used to do? That means it is a non-stationary time series, right? In case of a non-stationary time variable, you are not going to get time independent of mean, variance, and autocovariance. So if a variable is non-stationary, how do you detect? There should be a strong trend involved, either an upward trend or a downward trend. So if that kind of trend is involved, I will also tell you what are the statistical procedure to do that. If a trend is involved, how you are going to treat that? That means you have to remove that trend to make it stationary. For example, you have to remove that trend means how we are going to do? You are going to differentiate that series. If a GDP data is there and if you are finding a strong upward trend, to make it de-stationary, what you have to do? You have to differentiate that series. GDP T minus GDP T minus 1, GDP T minus 1 minus T minus 2. Likewise, you have to differentiate that series. And once you differentiate that series and you try to put that in a coordinated plane, two-dimensional coordinated plane, you are not going to get any trend. You are going to get a zigzag line. That means it is completely stationary. So stationary series does not involve with any kind of trend. Your stock return is a stationary series, but with a stock price at closing price, if you will take at level, it is a non-stationary series. So to make a non-stationary process to a stationary, you need to apply the differencing, and after that there are different kind of statistical tests you have to implement, like your Dickey-Fuller, Augment Dickey-Fuller, Phillips-Perron. I will explain in a minute how to make it stationary. So that is why what we understand from here, we understand here that in a non-stationary series there is a strong trend involved, either upward or downward. But in case of a stationary series, there is no trend at all because you are differentiating that series to make that trend out. Okay. So in this case, what you have to do, you have to first check your stationarity. Okay. So a stationary time series, I have already said that it has a constant mean. Variance and autocovariance are different lag periods. And then you have to apply the differencing series. Then you have to apply the different kind of statistical test like your Dickey Fuller, Augment Dickey Fuller, or your Phillips Perron test, or your KPSS test. Okay. By applying the statistical test, you have to make ensure that that is stationary or there is no unit root problem is there. And second, we have discussed about the stationarity or seasonality. So what we said that there are many procedure or there are many literature, they are actually arguing that first you have to go for the stationarity, then you have to come for the seasonality or you have to address the seasonality. Okay, I have already said to do the non-seasonal, a seasonal series into a non-seasonal procedure, either you go for the seasonal differentiating, or you can go for seasonal dummies, or you can do the seasonal decomposition. What is seasonal decomposition? Separate the time series into trend, seasonal, and residual components by understanding the model of the seasonality. As I said, people used to apply the Hodrick-Prescott filter test to divide the series in terms of a trend part, cyclical part, irregular part. Or through your X12 method, you can divide that series into these three parts and try to learn what kind of trend it follows. Likewise, people are also doing the seasonal ARIMA method. So ARIMA method is actually a univariate forecasting or a Box-Jenkins methodology in terms of the time series parlance. It is called as auto-regressive integrated moving average process. What I said, each of your time series variable, either it has to be expressed in terms of your auto-regressive process or moving average process. What do you mean by auto-regressive process? Today's current GDP, current quarter GDP is a function of the previous quarter, day of the previous quarter and all, plus some of the error term. For example, whatever that UT, disturbance term or the white noise term, you are taking at the different lag past, T, T-1, T-2. So every time series is actually explained in terms of a autoregressive process, in terms of a moving average process. What is moving average? Whatever the error term you are actually included, if you are taking error terms, it's low on lag past. Today's error term, that epsilon T is a function of T-1. That means MA of order 1, T-2 order 2, T-3 order 3. So each of the time series variable is either explained in terms of a autoregressive process by including its own lag past, or in terms of that own errors lag past, that is moving average process, or it might be a combination of AR and MA to get your significant values, how it explains, which is called as ARMA process. So if you are taking that seasonality over there, so it is called as the seasonal ARIMA process, auto-regressive integrated moving average process. Okay. Now the question comes, why stationarity first? What are the different reasons why you should consider the stationarity first in terms of your time series regression model? The first one is called as your model assumption. So many time series models, including your ARIMA and ARMA models, they assume that data is stationary. For example, call money rate. Call money rate, even label itself is stationary. There is no trend over there. So addressing seasonality in a non-stationary series can lead to incorrect conclusion, because the non-stationarity can mask or distort the true seasonal part. If a seasonality is involved, if you are first going for the non-stationary to stationary series, it will distract the seasonality there itself. You don't need a further seasonal procedure. If you are going to treat all the variables in the similar way, first stationarity and then seasonality, you are extracting or you are throwing a lot of information outside of the data. So whatever the little information is there, that you are considering to model actually. So that is why you should go for the first. First is the stationarity. And order of differencing. As your time series model is only deal with your stationary series, if you have a non-stationary variable, you have to keep on continuing unless until that non-stationary becomes stationary. So you never know whether it will be stationary in the first difference, second difference, third difference, fourth difference, so forth and so on. So you keep on differentiating till the time it will be a stationary variables. And by doing that, you are throwing out a lot of information out of it. So that is why your order of differencing plays a very important role. And this series is a non-stationary due to both the trend and maybe because of the seasonality also. So trend differencing and different stationary. Trend stationary and different stationary. With a trend, your process can be stationary. There is a trend means there is a upward trend or downward trend. Different stationary means after difference, it becomes stationary. So this is also followed by your seasonal differencing procedure. What are the practical workflow? So test and transform of the stationarity. Use test like your Dickey-Fuller, Augment Dickey-Fuller, KPSS test for your stationarity procedures, or identify your model seasonality by applying your seasonal differencing procedure, seasonal decomposition, or your seasonal ARIMA method, or I said that whatever that X11, X12, X13, the additive procedure or your multiplicative procedure. So that is why you have to go for the first one is called as your stationarity. Then you have to go for your seasonality. So typically you have to handle your stationary data first. Then you should meet your assumption of the stationarity. Then you have to go for the seasonality. And this sequence, why you should follow? Because it helps you to ensure that the time series model is appropriately specified and produces reliable forecast. Otherwise, there is a very chance that you may not get a unbiased, consistent, and efficient estimator. So that is why time series is always deal with this kind of concepts. Now, is my slide is visible now? Yeah.
Yes, sir.
Yes, sir.
Okay. So you can see the slides, right? Now, what I can do actually, I will give you some kind of examples of the predictive modeling where actually time series actually used. So it is in the slide, full slide mode. You can see it, right?
Yes, sir.
Yes, sir.
Yeah. So most of the time we are actually dealing with the demand forecasting. What do you mean by this demand forecasting? So demand forecasting is nothing but it's a kind of activity where you are actually estimating the quantity of a product or service that consumers will purchase. Especially in a daily life, we are actually using for the demand forecasting. And demand forecasting, it involves including both the informal methods, such as educated guesses, or your quantitative methods like your historical sales data or current data from test markets. And demand forecasting may also be used making your pricing decision, assessing future capacity of the requirements, or making decisions on whether to enter a new market. These are the different kind of analysis we are doing from the consumption perspective, supply side perspective, or from the pricing perspective. Okay. The next one is called as where you are actually using this kind of forecasting. So whenever you are talking about the forecasting, we used to do, for example, in case of the GDP, we have short-term forecasting, we have medium-term forecasting, we have long-term forecasting, or we are taking any kind of, for example, you might have seen in the different kind of data, before estimation, revised estimates, or forecasted estimates. So how they are going to deal with? So whenever we are talking about short-term forecasting and the long-term forecasting, how short is short and how long is long? Is there any near economic unanimity or near statement-wise unanimity that you can say that this is what short-term, this is what long-term? So with the economics, we are using a very vague term in terms of the short-term, medium-term, and long-term. because there is no such near unanimity is there in terms of definition how short is short or how medium is medium or how long is long. Only in the financial market, depending upon your time maturity, your short term or long term is defined. What is that called? If the time maturity is less than 364 days or less than 1 year, it is called as short maturity. And if it is above than 1 year, it is called as the long term instruments. So that is why in case of the short term forecasting, appropriate production scheduling, determining the appropriate price policy, setting sales target and establishing controls and incentives, evolving a suitable advertising and promotion campaign, or forecasting the short-term financial requirement or the supply chain bottlenecks. So we are dealing with this kind of forecasting in terms of the consumer behavior, in terms of production cycle, in terms of the market demand. And in terms of the long-term forecasting, we have planning of a new unit or expansion of the existing unit, depending upon the total factor productivity, innovation from manufacturing sectors, service sectors, and all. Whenever you are dealing with this kind of analysis, we used to do a long-term planning and planning long-term financial requirement. For example, let us say most of the people, they are actually investing in terms of your mutual fund, systematic investment plan, retirement fund, or pension fund. For example, you all are working now in an insurance factor or insurance factory or insurance sector, and you would like to estimate how much you are supposed to invest now, so that the moment you are attaining the age of 60 or 62, you would like to receive, let us say, 30,000 per month. To receive 30,000 month whenever you are going to attain 62 in your near future, how much money you should save over here. So how you are going to declare, how you are going to design that kind of amortization schedule to encourage a financial product, and you are giving that way insurance factor. Or how these mutual funds, how they are managing your wealth by taking your saving and parking into the different investment horizon, and they are making ensure that your wealth is actually increasing in a multiplier rate or your accelerator rate. So what kind of planning or what kind of planning a farm or industry is doing in terms of lower interest rate scenario or a higher interest rate scenario, or planning of a manpower requirement of a particular company, or in terms of the employment forecasting or unemployment generation. So there we are also doing a different kind of forecasting where we are actually using this kind of instruments. What are the length of forecast? So short-term forecast we are doing up to 12 months. For example, your sales, quotas, inventory, control, productions, schedules, planning cash flows, capital budgeting, cost benefit analysis. All these are called actually your short-term forecast. What are your medium forecast? Your 1 to 2 years, like rate of maintenance, schedule of operation, budgetary control over expenses, deficit, fiscal deficit, government revenue minus government expenditure, state fiscal deficits. All these things are called as your medium term. And what are your long term? 3 to 10 years. Example ratio is your capital expenditure, personnel requirements by a particular farm, industries, or investment analytics, financial requirements, raw material requirements, or long-term forecasts are more uncertain in nature. The more you forecast for the long, a lot of uncertainty is actually involved. Even though you are going to quantify with a likelihood of the assets, but there is every chance that in the long term, it might not converge actually whatever you are forecasting. So criteria for what kind of good forecasting method? One is called as accuracy, simplicity, economy, availability, and maintenance of the timeliness. So accuracy of the forecasting is very important. You are applying a regression method. You are actually dividing in sample and out sample. You are building your regression model, generating the parameters. Out sample you are using as the forecasted value, and you are testing the robustness of your forecasting method. That is called as the accuracy and checking with your actual figure. Second one is called as the simplicity and ease of comprehension. Your model should not be that complicated so that one cannot understand this. So that is why you need to prove on the practical and the actual data whether your model actually works. What we call it as the back testing and stress testing. Economy, different condition of the economy, whether the economy is in the normal period, recession period, or boom period, or the recovery period. So your forecasting is with respect to what different kind of situation of the economy, because every situation cannot be generalized. Availability and maintenance of your timeline list. What are the different approaches of the forecasting? Where you should start with a modeling. For example, whenever you are doing a regression, you are defining the average change in the dependent variable, or based upon your explanatory variables, variability power, you are forecasting. So where do you start actually? So many of the time, what we have seen, how to identify. For example, you have defined your research question. You would like to see the impact of women harassment during the COVID-19, let us say. The harassment or the vulnerability within the working women or non-working women, or during the home managers during the COVID-19 time, let us say, or any other social objectives, whatever you are dealing with. So what kind of research question you are actually phasing out? What are your expectation of these variables? Whether you are thinking that the vulnerability is more that you are getting from your previous research, now what they are calling it as a metadata analysis or your bibliometric analysis, and on the basis of that, how you are identifying the variables. If a particular variable is not available, are you considering any kind of proxy variables? What is the likelihood associated that whatever the proxy variable you are taking, that can be suitable for your targeted variable, and it can be interpreted or generalized for the population. Second one is called as, once you identify the variable, whether you have the sufficient or the relevant information to measure that whether it is available or not, the greater relevant data, authenticity of the data, compare the qualitative or quality of the data. Is there any missing data is available in terms of that? Depends upon the frequency of the data you are looking for, how you are treating that information, missing value treatment, because zero plays an important role. You cannot simply put zero. So that is why whether that missing data, whether what kind of methods you are actually implementing into that kind of missing data to fulfill that. So third one is called as, you're determining the most portable relationship. What kind of relationship you are expecting whenever you are framing your research question and identifying the variables. Whether the relationship is going to be positive or negative, whether it is going to be linear or non-linear, what your previous research is found from the different countries context, different zonal constant or different geographical context. What kind of methodology you are going to implement. Whenever this kind of methodology you are going to implement, what kind of relationship you are expecting. Whether it is going to be linear, non-linear, rectangular hyperbola, or any kind of other patterns. That is why determining the most probable relationship and what is your expected signs. Then you identify and clearly state the objective of your forecasting. Select the appropriate method of forecasting. Then identify variables. Then gather relevant data. Then as per the data and frequency, you need to apply the decision science tool. Then you determine the relationship, then you generalize. So this is a kind of circular causation among all these kind of steps while you are applying this kind of time series model for any kind of forecasting. Now, what are the different kind of methods are available for the demand forecasting? So some people are using the survey methods. Some people are using the Delphi method. Some people are using actually expert opinion method, collective opinion method, naive method, smoothing techniques, moving average procedure, exponential smoothing approach, or your use economic different indicators, or controlled experiments, or judgmental approach. So let us go to some kind of examples first. I'm not going to all this kind of forecasting method directly. I'm directly going to your direct some kind of case studies. So look at these case studies. Let us try to understand. So here, the case study one, the objective is that The model is a simplified version of Moody's factor model for computation of systematic risk for companies. So you might be knowing that we have different kind of rating firms. So international rating firms is our Moody's, Standard & Poor, and Fitch Rating. In case of India, we have CRISIL, ICRA, and CARE ratings. So what they are doing, the companies are divided into different kind of firms like financial firm and non-financial firm. Each of the financial firm and non-financial firm, they have the systematic risk or the market risk. Okay. So the model is like to a simplified version of the Moody's KMB factor. They would like to compute the systematic risk. What is the objective? This model computes the systematic risk in terms of value for any company based upon 3 factors. Like let us say country of incorporation, industry sector size, or the original Moody's KMB factor model use 120 factors. For example, let us say forget about this. Let us say bank's lending rate. All of you must be knowing that our public sector banks, what they do, they used to accept the deposits from the customers and they used to disburse the loans to the customers. So whatever the rate they are disbursing the loans to the customers, that is called as the lending rate. So that is the actual terminology called as the prime lending rate. You know how prime lending rate of each of the bank is different. If you compare the prime lending rate of the State Bank, Bank of Baroda, or Punjab National Bank, or Andhra Bank, or HDFC Bank, or ICICI Bank, you are going to get the different rates with the entire range actually. Now, if you would like to understand how this prime lending rate is actually determined and why it is different across the banks, to your surprise, the prime lending rate is a factor model which has actually 250 factors. Macroeconomic factors, industry specific factors, banking specific factors, asset specific factors, industry specific factors, sector specific factors, political factors, sociological factors, and your what is that called, bank specific factors. So if you take all these things, there are 250 factors and there are different geographies are there. So you have to consider the different geographies in your analysis, whether it is specific to the Asia Pacific, or Asia Pacific excluding Japan, or it is only your Middle East and Africa, or Europe specific, North American specific, Latin American specific, or whether it is kind of sector specific, industry specific, or any kind of that country specific factors. So these are the factors you have to has to taken into consideration before getting into this kind of forecasting analysis. So you have considered the following industries, let us say consumer discretionary, like non-durables, durables, energy, financials, healthcare, industries, information technology, materials, real estate. So we have different classification of the sectors. You cannot take only one and aggregated analysis and you cannot generalize that. So what I would like to tell you from this slide, that whenever you are actually putting any kind of demand forecasting model, before applying any kind of model or any specific objective, you see what kind of concentration this kind of industries are, whether it is financial or non-financial, whether sector concentration or non-sector concentration, industry, asset, everything, all aspect has to be taken into consideration before you are applying any kind of model. The second case study is that, let us say, to build a model that will forecast the total calls, inquiry, or loan received weekly as a function of weekly marketing spend. For example, you might have seen the General Motors, automobile sector and all. Nowadays, you have Kia Motors, you have actually this Maruti Suzuki, you have Toyota, you have General Motors. So let us say General Motors would like to see how much sales can possible in terms of this festival season. So you are planning a multiple regression model to go for a forecasting and all. So what kind of factors you are going to take into consideration? Or let us say a pharmaceutical industry, let us say monkeypox. So let us say Pfizer would like to bring a medicine for the monkeypox. Monkeypox has created a panic into the entire globe. Now WHO has already analyzed, already informed that monkeypox is actually a public health hazard for all the countries. 25 countries are actually infected, which was actually started from the Africa. Now, as there is no vaccination available in the market, how you are going to forecast how much the Pfizer is going to price for the monkeypox vaccination, and where it is available in the different geographies, what could be the price of that vaccine? So whenever you are analyzing this kind of analysis, you need to bring out all the sectorial concentration factors into the zone actually to do this kind of analysis. So in this case, let us say, as there are no medicines are available, so you do not have any peer group medicine or the subordinated medicine. So you don't know what could be the benchmarking price. You do not know how much panic it is going to create into the different kind of geographies. You do not know actually how the people are actually react, and what pricing mechanisms should be given, what could be the supply, what is the income group in that jurisdiction, whether they can afford it or not, whether the doctors are going to prescribe depending upon the candidacy or not. So there are a lot of factors are actually coming into the picture over here in order to understand this kind of analysis and all. So why I'm telling all these things? Because this is very important, that before creating your model establishing techniques should be specified. What we call in terms of our econometrics parlance, whether the model is actually properly defined, whether it is under-identified or the over-identified model. That has to be avoided actually. Okay. So likewise, different kind of, these are the different kind of checks that you need to keep in your mind. Now, let me directly come to a PPT to show you what are the different, whatever I have said you so far. Let us try to do with something with this package, which is called as a EViews package. My package is visible to all of you?
Yes,
Yeah?
sir.
Yeah. Now, let us say I have taken over here a variable called as a trade balance. Let me go to. Now, this is what my trade balance data is look like. So everybody understand what is trade balance, right? Yes. So trade balance is nothing but, have you seen a lot of negative numbers of the trade balance? And I have considered the data from 1990. It is a monthly data, 1990, April month onwards to 2024. The latest data is the July. So you might have seen a lot of negative figures over here. So what does that mean? The trade balance is negative. What do you mean by trade balance? Trade balance is nothing but whenever the import is actually dominating your volume and receipt of your export. Let us say, let us try to put it in a two-dimensional coordinated plane. I would like to see what kind of data it looks like and how it looks like. Let us go to the graph and let me put that in a two-dimensional coordinated plane. Is it visible to all of you, the trade balance data?
Yes, sir.
So in the x-axis, I have taken all the years. It is a monthly data from 1992 to the 2024. And in your y-axis, I have taken your all the trade balance values. Now, did you see any kind of pattern over here? Is there any trend involved? Do you see any trend over here?
Yes, sir.
What kind of trend it is?
For some period there is downward trend.
Yeah,
like
a
in
strong downward trend actually you might have seen over here, which is involved with this trade balance, right? There is a strong downward trend. Now, if you want to connect with your time series econometrics, what I said, a stochastic process is said to be weakly stationary if its mean, variance, and autocovariance at different lag are actually time independent. But here there is a strong trend involved. that means the series is actually non-stationary, right? By through your eyeballing exercise, you can say that this series is a completely non-stationary series. Okay, why? Because there is a strong trend involved over here. Okay, now let us see. Can I make it as a stationary? What do I call it as a unit root test? Okay, so if I'm going for a unit root test, okay, so let us go to a unit root test. So in case of a unit root test, what we are going to do, let us do a Dickey-Fuller test. So it is a label series. Okay, you might have seen over here in my pop-up box, there is a test for unit root. One is called as label, then called as first difference, then called as the second difference, right? And in the second, there are three kind of options are available: intercept, trend and intercept, and non. So what is involved with this intercept, trend, intercept, and non? Let us try to understand from these figures, from this slide now. Before examining that, let us understand what is this time series actually. Okay. As I have already said, a time series is nothing but a set of observation which is available at a regular time interval. The time frequency can be daily, monthly, quarterly, annually, quinquennially, or decennially. It can be anything. All the examples are your stock price, GDP, output, prices, exchange rate, and all. I have already discussed why one should bother about your seasonality because of the seasonal fluctuations, and whether the seasonality is fast or the stationarity is fast. That also we have examined, that first of all we should take the stationarity, then we should get into the seasonality. Now the time has come. Let us discuss about some of the properties of this time series data. What is the property one? The time series data have to expressed in terms of a autoregressive process or a moving average process or a seasonally dynamic process. I have already told you that if a series is defined of its own lag past, it is called as autoregressive process. If a series is defined of its own lag past of the error term, then it is called as a moving average process. Whenever you are combining own lag past with own lag error term, it is called as ARMA process. Because the time series data are ordered in time, that is why the past value influence the future values. Okay, so this is often results in a violation of your assumption of no serial correlation. In your classical linear regression model, your assumption is that there is no autocorrelation. That means y is not autocorrelated, y is not correlated with the x variables are not correlated with your error variables and all. So this often results in a violation of your assumption of your no serial correlation in the residual terms. That is why your covariance of summation I and j equal to 0. There is no autocorrelation, so I is not equal to j. This is also a time series property. Another important time series property is that time series data often have time dependent movements. It has mean, variance, skewness, and kurtosis and all. So the mean or variance of many time series increases over time. I have already told you why it is called as non-stationary, because it is not time independent. If you are computing mean, variance, and autocovariance at different time lag. Okay, so these are the different time series properties. So property 3 is that the sequential nature of the time series data allows for forecasting of the future events. If there is a sequential, that I am talking about your cyclical nature of that. Property 4 is your event in a time series can cause your structural breaks. So another important concept in terms of your time series forecasting model or time series model, apart from the stationarity and seasonality, is that structural break. Let me give you an example. Let us say you'd like to understand what is the impact of agriculture, industry, and service sector contribution in terms of the GDP with the different phases of the economic policies. For example, in 1991, you have a different economic policy. In 1998, you have actually your current account convertibility. And in terms of your 2007, it is a global economic crisis. And after that, in 2016, we have the demonetization. 2017, it is your GST implementation. In 2020, your different corona phases have happened. So whenever you are dealing with a time series, it is very much important that whether any structural break is there or not, how you are going to implement this kind of, how you are going to examine this kind of structural break. If you are not doing that and you are directly considering the model, that is going to create different kind of unbiased result or different kind of nonsense result. So in this case, what you have to do, there are different tests. For example, you must be aware of this Chow breakpoint test. Likewise, we have seasonality break test in the time series, and there is a parent trend break test. Or what you can do in a simple econometric parlance, all these kind of structural changes has to be incorporated with a structural dummy, and you need to test whether this kind of structural dummy is actually significant for you or not. So that is why the breakpoint test in case of the time series plays a very, very important role. And in your property 5 is that many time series are actually in an equilibrium relationship over time. So in the entire time series model, I have already said you that all the models of the time series can only be implemented into the stationary variable. So you have only one method which is available to apply on the non-stationary data, that is called as your equilibrium, that is called it as a co-integration test. What is co-integration test? Co-integration test is the only test in the time series model which is actually applied in your non-stationary variables. What they do, they would like to examine whether there is an existence of the long run equilibrium relationship in the future among your non-stationary variables. That is the only technique in the time series parlance where if you would like to examine the future existence of long run relationship, then only you can apply this kind of non-stationary data. That means if you are accepting this hypothesis, yes, there is an existence of the long run equilibrium relationship between these variables in the near future, that means you are actually accepting there are short-term deviations. So to examine that how much short-term deviation is there, to converge that in the long run, what you are doing, you are applying this kind of co-integration test. That is why error correction mechanism is actually measuring your speed adjustment parameter of short-term deviation, which is actually merged with your long-term. In your econometrics parlance, there are a lot of convergence theories. Convergence econometrics is actually applied this kind of co-integration technique. Like many times this data, they are actually endogenous. For example, in our classical linear regression model, we have a simultaneous equation system. I was giving you an example of this kind of portfolio balance approach. Like if your exogenous increase in the stock price, it will increase the demand for money. Demand for money will lead to your interest rate will go up. Interest rate will bring more foreign investment and exchange rate is appreciated. So this kind of model can be examined in case of the simultaneous equation system. Because in the simultaneous equation system, an exogenous variable in the first model cannot be endogenous variable. So simultaneous bias will be there. It might be over-identified, it might be under-identified. So that is why simultaneous equation system, you have to take care with the simultaneity. But in case of the time series variable, time series equation, whenever a time series model, whenever you do not have any kind of a priori information or theoretical information among a set of variables to explain them or to quantify that. So in that case, what time series model does? Time series model treats all these variables as the endogenous. Time series model values each of the variable is actually a dependent variable. So the moment you are assuming that it is a dependent variable is a function of all other variables in terms of its own lag past, what we called as the value vector autoregression model. So these time series models, they treats each of the values as a dependent variable, as a endogenous variable. What are the necessary and sufficient conditions to apply this kind of model? Whenever you do not have any theoretical a priori information. Then property 7 is saying that the effect of an independent variable on a dependent variable can vary over time. That you can estimate whether it is a static events, dynamic events with the different parameter models in order to capture the time dynamics. Okay, so these are the different properties of your time series model. Then why not estimate time series with an ordinary least square? Because your OLS estimators are sensitive to outliers. To understand the outliers, you might go to your arithmetic mean. In case of the arithmetic mean, it is actually biased towards your largest values. In case of the outliers, for example, if you are looking at the gold import during time of GST demonetization and all, or maybe in case of the deposit trend or lending trend. So these are the different outliers. Whenever it is available in the data, OLS estimators are actually biased towards that. So OLS attempt to minimize the sum of squares, as I have already said. What do you mean by your ordinary least square? By placing the greater weight to the first and last observation. OLS treats your regression relationship as the deterministic, but time series treats each of the things as your stochastic model. So you can do better modeling in terms of the dynamics, in terms of your seasonality, in terms of your stationarity, in terms of your long-term convergence, in terms of the breakpoint test, and in terms of your forecasting models. Okay, so if you look at the different kind of time series models, whatever is actually nowadays developed, the recent advancements of time series models is actually starting with your unit root test, where you are making the different kind of stationary variables. Then you are going for the Box-Jenkins methodology. What is this Box-Jenkins methodology? That is called as a univariate forecasting. Univariate forecasting by applying either a autoregressive process or a moving average process or a ARMA process or a ARIMA process. Then the second generation of the models are actually coming for your actually causal analysis. Nowadays, whether regression can examine the causal relationship, what are the drivers or whatever the driven, who is the cause and who is the effect, or what kind of causal dynamics, that plays a very important role. So time series econometrics provide you two variables causality analysis, what we called as the Angel-Granger causality test. Or if it is their multivariable, that kind of causality you are actually getting through your vector autoregression model, through your error forecasting variance decomposition method and your impulse response function. So that is called as a causality analysis. And the third one is called as your vector autoregression model. If you would like to look after the different kind of stochastical causality, what you are forecasting in your near future, what kind of dynamics, what kind of impulse response is actually involved in terms of propagation process, where you do not have any theoretical knowledge how the variables are going to deal with. So especially these kind of methods are actually used in order to derive the theoretical propositions through different kind of quantitative aptitudes. On a trial and error basis, you would like to examine the different kind of relationship with a different set of variables. That is called as Granger causality or your vector autoregression. Then you have the co-integration test in order to establish the long-run equilibrium relationship between the variables, or how much time it will take on an average so that this equilibrium relationship is going to be restored. That is called as your co-integration test. So there also you have Angel-Granger test, like two variable test, or you have Johansson maximum likelihoods estimation methods or Johansson-Jusselius procedure if you have a set of multivariables. Then you have the volatility analysis, what we called as the R school of models. That is also stemming from your classical linear regression model, because you are assuming that your variance is constant. but actually your variance is not constant. And if your variance is not constant, you are doing a conditional volatility models. ARCH, GARCH, E-GARCH, GMM GARCH, T-GARCH and all. And then nowadays, what is important in the time series actually, we are doing the spectral windows, wavelet analysis, then your stochastic calculus, stochastic volatility models, chaos techniques, and the artificial neural network and machine learning. My dear friends, nowadays it is people are talking about artificial intelligence and machine learning. But let me tell you, at the end of the day, it is just a statistical model. What are the different popular methods? Your random forest, support vector machines, your distance gradient boosting methods, your extreme distance gradient boosting methods. All these machine learning tools, they are actually nothing but the statistical models. Sometimes what we are doing, we are actually doing the K neighboring classification method, different classification of the data, your binomial regression model, your Poisson regression model, your different classification depending upon your the kind of probability distributions. So all these things we are actually implementing in the time series econometrics model to derive something, or how we are executing this kind of models. But before building any kind of models, as today's class, we have briefly discussed around 2 hours that what kind of challenges, what kind of issues, and what kind of solution you have to incorporate to make your model robust. Maybe I'll request Professor Minketan and all of you that we can plan for another model to get into actual the time series model, how you are going to estimate, how you are going to interpret, and how you are going to deal with these kind of things. So this is all about from my sides. If you have any questions, you can raise that. Thank you so much for patiently listening me out. I'm tired actually. Thank you.